One of the most popular strategies used in 0 days to expiration trading is the Iron Butterfly. This strategy involves selling an at-the-money straddle, which is a call and a put at the same strike price, while simultaneously buying out-of-the-money wings, a lower strike put and a higher strike call, to limit risk. The Iron Butterfly is a neutral options strategy that profits from low volatility and time decay. It involves a combination of selling and buying options to create a risk-defined position. This strategy is widely used in 0 days to expiration trading, especially in SPX options, due to its ability to capture premium while controlling risk. The Iron Butterfly consists of 4 options trades, structured as follows. First, selling an at-the-money call and put, which is the core of the strategy. The trader sells a call option and a put option at the same strike price, which is closest to the current market price of the underlying asset, typically SPX. This creates a short straddle, generating maximum premium, but also carrying unlimited risk unless hedged. Second, buying an out-of-the-money call and put for protection. To limit risk, the trader buys a higher strike call option and a lower strike put option beyond the short options. This creates a range, or wings, that caps both potential losses and margin requirements. Risk. The maximum risk is the distance between the strikes of the short and long options minus the premium received. Reward. The maximum profit is the net premium collected if the price of the underlying stays at the ATM strike price until expiration. Break-even points. The break-even prices are calculated as follows. Upper break-even equals the ATM strike plus the net premium received. Lower break-even equals the ATM strike minus the net premium received. The closer the underlying asset remains to the ATM strike price at expiration, the greater the profit potential. If the price moves too far in either direction, losses increase but remain capped due to the long options. How SPX options differ from other options. SPX options, which are based on the S&P 500 index, have unique characteristics that make them particularly attractive for Iron Butterfly traders. SPX options are cash settled. Unlike stock options, SPX options settle in cash, meaning there is no risk of being assigned shares. This is beneficial for traders who want to avoid the complexities of managing physical stock positions. Another feature is the European-style expiration. SPX options can only be exercised at expiration, reducing the risk of early assignment, which is common with American-style options like SPY or individual stock options. Additionally, SPX options offer 0 days to expiration availability. SPX options have expirations every trading day, making them ideal for traders looking to capitalize on short-term movements using strategies like the Iron Butterfly. There are also tax advantages. SPX options are treated under Section 1256 tax rules, meaning traders may benefit from a 60-40 tax treatment, where 60% of gains are taxed as long-term capital gains and 40% as short-term gains. Finally, SPX options tend to have higher liquidity and tight spreads. This high liquidity and relatively tight bid-ask spreads make it easier for traders to enter and exit positions efficiently. The 0 days to expiration Iron Butterfly strategy has gained popularity among traders due to its ability to generate quick profits while maintaining a defined risk-reward structure. By taking advantage of accelerated time decay, known as theta decay, and market inefficiencies, traders can capitalize on short-term price movements with limited capital exposure. Below are some key benefits of this strategy. 1. Defined risk and reward structure. One of the biggest advantages of the Iron Butterfly strategy is its risk-defined nature. Unlike naked options strategies where losses can be theoretically unlimited, the Iron Butterfly has capped risk and known reward potential. Maximum profit is achieved when the underlying asset closes exactly at the ATM strike price, allowing the trader to collect the full premium. Maximum loss is limited to the difference between the short and long strikes, or the width of the wings, minus the net premium received. Break-even points are clearly established based on the premium collected, allowing traders to gauge their risk-to-reward ratio before entering a trade. Having predefined risk parameters makes it easier to manage positions and implement effective risk control strategies. 2. Potential for quick profits due to rapid time decay, also known as theta decay. Zero DTE options experience the fastest rate of time decay, meaning their value erodes quickly as expiration approaches. This is beneficial for Iron Butterfly traders because the short ATM call and put options lose value rapidly, allowing traders to buy them back at a lower price or let them expire worthless for maximum profit. The passage of time works in favor of the trader, reducing the need for prolonged market exposure. Even slight movements toward the ATM strike price can lead to significant profit potential within hours. Since this strategy relies on fast premium decay, traders can execute multiple trades within the same week, compounding their potential returns. 3. Cost effectiveness compared to other strategies. Compared to other option strategies, the Iron Butterfly is relatively cost-effective for several reasons. First, lower capital requirement. Because it is a fully hedged strategy, the margin requirements are significantly lower than selling a naked straddle. Second, better premium collection. The combination of selling ATM options and buying OTM wings allows traders to collect a higher net premium compared to strategies like the Iron Condor, which has wider spreads. And third, no need for large market moves. Unlike directional strategies such as buying calls or puts, the Iron Butterfly profits even if the market remains stagnant, reducing the need for large price swings. This makes it an efficient choice for traders looking to maximize return on capital while minimizing overall exposure. 4. Suitability for volatile market conditions. Despite being a range-bound strategy, the Iron Butterfly can be effective even in volatile market conditions when adjusted properly. High volatility equals higher premiums. When implied volatility is elevated, the premiums collected from selling the ATM straddle are higher, increasing the potential reward. Adjustable strike selection traders can widen the wings of the butterfly, or shift the strikes to accommodate expected volatility swings. Scalability. If the market becomes unexpectedly volatile, traders can quickly roll their positions or exit early to lock in profits or minimize losses. By carefully selecting expiration day trades based on market conditions, traders can optimize their risk-reward ratio and take advantage of intraday price movements. The 0 days to expiration Iron Butterfly strategy requires precise execution, given its short time frame and sensitivity to market movements. This step-by-step guide outlines how to analyze the market, set up the trade, manage risk, and exit efficiently to maximize profits. Before placing an Iron Butterfly, traders need to assess the market environment to ensure it aligns with the strategy's strengths. The Iron Butterfly works best when the underlying asset, for example SPX, is expected to stay within a tight range. Ideal conditions include low to moderate intraday volatility, around 10 to 20%. A calm market that moves sideways or fluctuates within a defined range is ideal. No major economic events. Avoid trading on days with significant announcements like FOMC meetings, CPI reports, or earnings releases, as they can trigger large price swings. Support and resistance levels. Identify key levels where SPX is likely to consolidate using technical indicators such as moving averages, VWAP, or Bollinger Bands. High implied volatility equals higher premiums. Elevated implied volatility leads to higher option premiums, increasing the potential credit received. Stable implied volatility equals better predictability. If implied volatility is stable, price movements are more predictable, reducing the likelihood of sharp moves against the position. Watch for breakouts. If SPX is trending strongly or breaking key support or resistance levels, an Iron Butterfly may not be ideal. An alternative strategy like an Iron Condor may be preferable. Best times to enter mid-morning after the market opens, when initial volatility settles. Avoid trading around major economic news or earnings reports. Monitoring time decay dynamics, rapid time decay in the afternoon can favor this strategy. Trade duration and exit strategy. Ideally, stay in the trade for 1 to 3 hours, depending on SPX price movement and time decay. Safe profit exit point. Exit when at least 10% of the maximum profit is achieved. Loss exit point. Close the position if losses exceed 20% of the initial credit received. Once the market conditions align, the next step is to construct the Iron Butterfly trade. choosing strike prices based on SPX's current level, short strikes, ATM call and put. Select the strike price closest to SPX's current price. This forms the center of the Iron Butterfly. Long strikes, OTM call and put for protection. Choose strike prices a few points away from the short strikes to cap risk. The width of these wings determines both the max risk and margin requirement. Sell 1 ATM 5,675 call. Sell 1 ATM 5,675 put. Buy 1 OTM 5,705 call for protection, 30 points above. Buy 1 OTM 5,645 put for protection, 30 points below. Calculating potential credit and risk. Maximum credit, potential profit, equals total premium received from the short options minus the cost of the long options. In this case, the total premium collected is $38, $3,800 per contract. Maximum risk equals the difference between the short and long strike prices spread width minus the net premium received. $3,000 minus $3,800 equals negative $800 per contract, meaning the trade starts with an immediate profit. Max reward equals $3,800 per contract if SPX stays at 5,675 until expiration. Risk to reward ratio. Risk equals $800 per contract. Reward equals $3,800 per contract. Risk to reward ratio equals 1 to 4.75, a very favorable setup. By collecting $3,800 in premium while having a maximum risk of $800, this trade presents an attractive high-reward, low-risk opportunity, ideal for a well-structured zero DTE Iron Butterfly. A well-structured trade should aim for at least a 1-to-1 or better risk-to-reward ratio to ensure favorable profitability. Once the trade is placed, active monitoring is crucial given the rapid price fluctuations in zero DTE trading. Managing the trade throughout the day. Ideal scenario, SPX remains near the short strike price, for example 5,675, causing both the call and put options to decay quickly, allowing the trade to expire profitably. Unfavorable scenario, SPX moves significantly away from the ATM strike, increasing the risk of a loss. Adjusting positions to mitigate losses or lock in profits. If SPX moves away from the at-the-money strike, consider rolling the position to a new strike price closer to SPX's current level. If you want to play it safe, when profit reaches 10% of max potential, exit early to secure gains and avoid last-minute price swings. If the market is trending, convert the Iron Butterfly into an Iron Condor by widening the wings or shifting the short strikes to reduce directional exposure. Hedging with a stop loss. Consider using stop loss orders on individual legs, or closing the trade if the loss reaches a predetermined percentage, like 20% of the max loss. Deciding when to exit. At expiration, if SPX stays near the at-the-money strike, let the position expire for maximum profit. Before expiration, close the position early if the market starts moving aggressively, locking in profits before volatility increases. Trailing exit strategy. If the trade is profitable but price action becomes unpredictable, close it in increments like closing half the position first, then monitoring the remainder. Time decay considerations. The closer the options get to expiration, the faster they lose value. If SPX remains within the profit zone as expiration nears, theta decay works in favor of the trade. However, late-day volatility spikes can occur, making it crucial to stay vigilant and exit before a significant market move erodes profits. Risks and challenges of the zero DTE Iron Butterfly strategy. While the zero DTE Iron Butterfly can be a highly profitable strategy, it also carries inherent risks due to the short time frame and sensitivity to market conditions. Traders must be aware of these risks and implement proper risk management techniques to mitigate potential losses. Potential losses if SPX moves significantly beyond break-even points. The Iron Butterfly is a range-bound strategy, meaning it profits when the underlying asset, SPX, stays close to the at-the-money ATM strike price. However, if SPX makes a strong directional move beyond the break-even points, losses can accumulate quickly. How losses occur. If SPX moves far above the ATM strike price, the short call will increase in value, leading to losses. If SPX moves far below the ATM strike price, the short put will increase in value, also causing losses. The long OTM options, wings, limit the maximum possible loss, but if SPX moves significantly, traders may still face substantial losses relative to their premium collected. Example, loss scenario. Suppose SPX is at 5,675, and you set up an Iron Butterfly with short strikes at 5,675, and long strikes at 5,705, call, and 5,645, put. The break-even points are calculated as upper break-even equals 5,675 plus 38, premium collected, which is 5,713. Lower break-even equals 5,675 minus 38, which is 5,637. If SPX moves beyond 5,713 or below 5,637, the position starts losing money. A sharp move to 5,720 or 5,630 could result in near max loss, $800 per contract in our example. How to manage this risk. Monitor key support and resistance levels to anticipate potential breakouts. Exit early if SPX approaches a break-even point to prevent further losses. Use stop-loss orders or manually close the position if losses exceed a predefined percentage, for example, 20% of max risk. Impact of sudden changes in implied volatility, or IV, can be quite significant for the Iron Butterfly strategy. This strategy is highly sensitive to changes in IV, which can dramatically affect option prices and overall profitability. How does IV affect the trade? Well, a drop in IV actually helps the trade. Lower IV causes options premiums to decrease, which benefits the Iron Butterfly by allowing traders to buy back short options at a lower price. If the SPX remains stable, a drop in IV leads to faster profit realization due to increased time decay. On the flip side, a spike in IV hurts the trade. Increased IV inflates option premiums, making it more expensive to buy back the short options. If SPX moves unpredictably, higher IV increases the probability of breaching break-even points, leading to potential losses. Let's look at an example of worry impact scenario. Suppose SPX is trading at 5,675, and implied volatility is 15% at the time of trade entry. If an unexpected news event causes IV to jump to 25%, the value of the short options rises sharply, making it expensive to close the trade. Even if SPX remains near 5,675, the higher IV can cause the position to show an unrealized loss due to increased extrinsic value in the options. So how can you manage this risk? One way is to trade when IV is high and expected to drop. Enter Iron Butterfly trades when IV is elevated but likely to decline, such as after economic reports. Another approach is to avoid trading near key market events. High-impact events like Fed meetings, CPI data, or earnings releases can cause IV spikes, increasing trade risk. Lastly, consider using a wider spread if IV is high. When IV is elevated, widening the wings of the Iron Butterfly can help absorb potential fluctuations. Importance of disciplined trade management. Successful execution of a 0 days to expiration. Iron Butterfly requires strict discipline in position sizing, trade adjustments, and exit strategy. Failing to manage the trade properly can lead to significant losses. Key trade management principles. Set clear profit and loss targets. Aim to close the trade when at least 10% of the max profit is reached. Cut losses if the trade reaches 20% of the max risk to avoid full loss scenarios. Monitor the trade actively. Since 0 days to expiration trades move fast, constant monitoring is crucial. Be prepared to adjust or exit if SPX moves against the position. Be prepared to adjust the trade. If SPX moves near a break-even point, consider rolling the short strikes to align with the new price range. Converting the Iron Butterfly into an Iron Condor to adjust risk exposure. Exiting early to limit losses and preserve capital. Avoid over-leveraging. Due to the high reward potential, it's tempting to size up aggressively. Use proper position sizing to ensure that a single loss doesn't wipe out multiple wins. Tips for a successful 0 days to expiration Iron Butterfly Strategy. Executing the 0 days to expiration. Iron Butterfly effectively requires a combination of technical analysis, risk management, and market awareness. Here are some key tips to improve success rates and optimize profitability while managing risk. Use tools like risk graphs and break-even calculators. Understanding risk-reward dynamics is crucial when trading a 0 days to expiration Iron Butterfly. Utilizing risk analysis tools can help visualize potential outcomes and make informed trading decisions. Risk graphs show a visual representation of profit and loss scenarios based on SPX's movement. How they help. Identify break-even points and potential profit zones. Analyze the impact of market moves on profitability. Determine maximum loss scenarios before entering the trade. Break-even calculators, what they do. These calculators compute the exact price levels where the strategy transitions from profit to loss. How to calculate manually: upper break-even equals ATM strike plus premium collected. Lower break-even equals ATM strike minus premium collected. If SPX is trading at $5,675 and the total premium collected is $38, the break-even points are: upper break-even, 5,675 plus 38 equals 5,713. Lower break, even 5,675 minus 38 equals 5,637. Tip: many broker platforms like Thinkorswim, Tastytrade, and Interactive Brokers provide built-in risk analysis tools. Set clear profit targets and stop-loss levels. Since 0 DTE trades move rapidly, setting predefined profit and loss thresholds prevents emotional decision-making and minimizes risk exposure. Profit target strategy. Ideal exit is to aim to capture at least 10% of the max profit rather than holding until expiration. Why? Reduces exposure to sudden market reversals, avoids last-minute volatility spikes that could erode profits. Stop-loss strategy. Exit when loss reaches 20% of max risk. For example, if the max loss per contract is $800, consider exiting when the loss hits $160. Also, use a time-based stop-loss. If SPX moves against your position early in the trading session, consider adjusting or exiting. But if SPX remains near the short strike, hold until later in the day when theta decay accelerates. Trailing stop strategy, which is all about locking in profits. If the trade becomes profitable, scale out of the position gradually instead of closing it all at once. For example, you might close 50% of the position when profits reach 50% of max potential. Hold the remaining position to capture additional decay while monitoring market conditions. Stay updated on market news and events. Market-moving events can disrupt price stability and create unexpected volatility, making it crucial to track economic reports, earnings, and Federal Reserve updates. Major price swings can increase the likelihood of breaching break-even points. IV spikes before the event and crashes after, affecting premium pricing. The best approach is to avoid opening new positions before major news releases. Earnings reports on major index components can be pivotal. Companies like Apple, Microsoft, and Tesla have significant weight in the S&P 500. A surprise earnings report can cause SPX to gap, making range-bound strategies like Iron Butterflies riskier. The best approach is to check earnings calendars and avoid 0 DTE trades on days when key components report. Federal Reserve announcements, such as interest rate decisions or Fed speeches, often cause rapid movements in SPX. The best approach, if trading on Fed days, is to consider wider wings or lower position sizes to manage risk. By following the best strategies and practices, traders can enhance their consistency and profitability. Thank you for watching. If you found this video helpful, don't forget to like, share, and subscribe to our channel for more insightful trading tips and strategies.